AIM-listed Benz Creek is a metallurgical coal producer based in West Virginia. It's mostly high wall mining and as such presents a relatively low operational risk. Benz Creek has recently appeared on the list of most active stocks on the IG investment platform. And I have to say before I get going on the interview that I am also a shareholder in the business. Let's now catch up with the Chief Executive of Benz Creek, Adam Wilson, who joins us now from West Virginia. Adam, it's good to be able to talk to you. And I know I'm talking to you as a fellow shareholder as well. I think you own around about 8%.
We welcome you on board. We welcome you on board.
Well,
thank you very much for the confidence, and very nice to see you from sunny West Virginia. Although I understand it's even sunnier back in the UK at the moment.
It's very warm, but I want to talk about what's going on, if I can, at your operation there in West Virginia. First of all, I'd like, if I can, to get you to explain more about what's happening at Benz Creek and why, more importantly, metallurgical coal.
Sure. Well, metallurgical coal has often been tied in with coal per se. There's not always been the distinction between thermal coal, which is the coal that is burnt for power, and often the more dirtier coal, because it is the lower quality coal. It has more ash and it's burnt in a power station, and a lot of the ash goes into the environment. And metallurgical coal, which is an absolute requirement for the production of steel. There are only two ways to make steel. One is in first principles, you basically mix iron ore with met coal, and it's the carbon from the met coal that you're putting in the blend. And that's when you put it through a blast oxygen furnace and you make steel in first principles. The second way to make it is by melting down already purposed steel, repurposing it, if you like. And again, you need to inject carbon, which comes from met coal, to re-strengthen it and take out the impurities. So there is a little bit of hydrogen produced steel, but it takes so much energy, very inefficient. 90% of the world's steel is made with iron ore and carbon. And met coal in particular is having a bit of a renaissance, if you like, because years of decline on thermal coal production, with the environment really against it, meant that met coal supplies have gone down. They're normally mined together. Met coal is essential even for the green economy. Funny enough, it sounds almost paradoxical, but you can't build windmills in the Pacific or solar panels across the Midwest. They have to be made of steel. They're not made of wood anymore. So also the electric car revolution, you need stronger, lighter steel to make those cars. The best example there is Tesla, probably one of your more active stocks, even more than Benz Creek. Tesla make their electric cars they're made of carbon fiber, and then they have boron steel in each pillar. Boron steel is a specialty steel, has to be stronger and lighter. And basically, you're putting more carbon in and less iron ore. So right across the economy, you're seeing a big movement, a big demand for met coal. In the greener economy, then of course you can move on to defense. Obviously, post the war with Ukraine, most NATO countries now are going up to the 2-3% GDP spend on defense. Most of that, again, will involve steel, and so you need met coal for the new tanks and rockets that are being built. And lastly, you'll have seen the US, India, and Pakistan now passing large infrastructure bills to regenerate this infrastructure, again, all needing met coal for steel. So three big drivers of demand that haven't really previously been there, all coming on board at the same time.
Okay, let's put all this together then, work out how Benz Creek fits into this in terms of supplying this high demand that you're now seeing. Explain more about this high wall mining process that you're undertaking at Benz Creek.
Sure. So what you had traditionally is miners mining all coal together. As you mine down, you'd find steam coal and you'd find met coal, depending on the chemical qualities. The steam coal went to burn in the power stations. The met coal would be used for steel. You've had years of decline, almost generational decline in in thermal coal mining because of its unenvironmental friendly impact. We set Ben's Creek up. We bought a bankrupt mine from Investec. So there was $60 million of infrastructure in Ben's Creek when we acquired it. That $60 million of debt we transferred into a royalty. So we wiped off 60. That's where the railway line and the wash plant were already constructed. They needed remediating, but they were already there. Had a railway line to the middle of West Virginia. And what we did at Ben's Creek is we designed to only mine the met coal seams. So that's a great statement to put out. But how would we be able to just pick the met coal seam? So we're using a technology called a high wall miner. So we don't take the mountain apart, which is what used to happen, and take all the overburden, the earth out, take the coal seam, and then rebuild the mountain. We don't do that. We're much more environmentally friendly. We produce a high wall miner machine, and it basically is a drill, huge machine with a drill that only selects the met coal seam, and it goes back 1,000 feet, so a long way back into the mountain, but it basically leaves the mountain intact. Then it moves forward 50 feet. We bolt to support where we've just taken the coal out, roof bolt it, fill it back in with spoil, move along 50 feet or whatever the engineers tell me is the required gap, and then go again and go again. And then we put earth in front of it and immediately reseed it. So it is minimal, absolutely minimal impact on the environment. It is the least evasive way, and the mineral that you need, the carbon, is an absolute requirement if you're going to try and, you know, the three things we talked about: move towards a greener economy, and you need the steel for that, defense spending, all of the requirements for infrastructure. You know, you need this mineral. There is no other replacement in the production of steel. So this is the least evasive way of taking it out of the best for the environment.
My understanding is you've got one high wall mining bit of equipment in place and working, and you've got another one standing in the wings. Is that right? Is that going to come online?
We've actually got two. We've got one working. We've bought another one, which is just being repaired, and we've got a third one on order. So we will have three. Previously, we had thought that the permit would only carry 2 high wall miners. And so when we listed the company, we were looking for a production of about 40,000 tons a month. We're already at that production now. So we only listed 6 months ago. And when we listed, we needed the listing proceeds were to remediate the infrastructure that we acquired. So the railway line needed fixing. We've done that. And inflationary costs are such that we were lucky that we did it when we did, because now all of the wood and the steel and the stone, they've all shot up in price. But we managed to get in front of that. We've remediated the railway line. We've put the benches in. We managed to get all that done very quickly after listing. We're now producing 40,000 tons a month from one high wall miner. We're waiting on a second permit, which is imminent. Once that second permit is in place, I had told the market we'd probably put the second high wall miner there. So we're looking to increase production. We're now looking, and this is the first time we've really been positive on that. There is no guarantee, so I'm not guaranteeing. We might be able to fit the third high wall miner as well on that permit. Doing the mine planning, that would further increase the production through the 80,000 tons we would hope to get to by using the second high wall miner. That would be a real benefit. That won't happen till the new year, and it will take a little bit more work on mine planning just to ensure, because you have to advance in front of the miner, and we're very, very keen on reclaiming as soon as the miner moves through. So minimal evasion on the land. So we just have to make sure that that's feasible, but it's looking more likely than not now that we will be able to have all 3 high wall miners working on the site into next year.
How does the permitting system work? Are you permitted to go depth into the mountain, or is it the width of the spread?
It's the whole job. So you've got a big reserve. You permit bit by bit, normally sort of for 5 years. So this permit we're looking at, this mine previously was underground mine. It had one small high wall permit when we acquired it, We needed that to get into production. This new permit is for a much bigger area. It's put specifically for high wall mining. You know, I know that we're going to get it because it's a bit like a listing on AIM. You apply to the stock market, they then give you your questions back, and it's an iterative process. So they don't get to ask new questions every time. You just, you know, deal with their answers. So we put this application in about a year ago. We're just down to final signature sign-offs, and a couple of the people we need signing off have been on vacation. So it's imminent, and that permit will allow us to run 2, maybe even 3 new high wall miners in the fashion that we've discussed. Anybody of your viewers are welcome to go on and have a look at a high wall mining video. Shows you exactly how it works. And so this is quite a big area we're permitting. We went from an underground mine to a high wall miner. So this is a key and very exciting permit for us to get, and it will keep us in production for a long time going. And the permits are normally 5 years with a 5-year renewal. And we're very keen. We're not required to remediate or reclaim immediately. You have a period of time. We're ahead of that. So DEP have been the Department of Environmental Protection have been impressed with what we've done so far. And it's part of our ESG strategy. Instead of waiting, as soon as we go through the section that the miner moves through, we put the earth back, we reseed immediately. You can see it on some of our videos on the, so that is a big benefit. They like that a lot. This is the least invasive mining technique available, and we're reseeding as we go. So as soon as we get these permits, we will, you know, be able to ramp up the production.
Yeah. Talking about ramping up production, what's the offtake demand like at the moment? You talk about the areas where there is a high demand for this sort of metallurgical coal. Who's taking your coal that you're producing at the moment?
So most of our coal is sold export. We have just locked in a load of transport. There is a kind of a one-off, if you like, event. It certainly has affected our share price. What you have at the moment, the war with Ukraine, on the 10th of August, it becomes law on 27 countries around the world that they are not allowed to buy Russian coal. So it's illegal. It's not a sanction. It's just illegal. So nobody would be able to purchase any of that coal from the 10th of August. So prior to that, the met coal's gone from sort of $450 a ton and has had come under pressure as the Russian suppliers have tried to sell as much coal as they can. And clearly the buyers of that product, steel producers, have been buying that coal ahead of August the 10th. But that pressure will come off from August the 10th. You never know. I'm giving you my prediction. Things have a funny way of not happening, but all things being equal, after August the 10th, we should see a recovery in the met coal price. Inflation, you know, I'm sure on your show you've been looking at the inflation figures. Their prices are rising. It is likely that the met coal will return to where it was previously after we've had this one-off sale of Russian coal ahead of the sanction. 27 countries are signing this sanction. It's easily Googleable, if that's a word. You can Google it, I should probably say. So that comes in on August the 10th. So I think that you will see, and what you're seeing at the moment is a lot of the steel companies, the big steel companies, trying to get fixed pricing whilst the price are low. We've resisted that. We have signed 8 cars. I've got 8 more cars that I recently signed on top of our offtake thing. And we did fix a price there with a good margin, which is above where the price of the coal is at the moment. So that's good news for us. But really, we're in it for the long term. So 8 cars is about 100,000 tons. After that, we will go back to the index pricing, which I hope will pick up again once this Russian ban comes in. The people that are buying the coal, you know, the steel producers, etc., the ultimate spender on it, either infrastructure, defense, or even, you know, moving towards a green economy. These are all government spend. This is not individual consumer spend who finds it too expensive. If you're buying new tanks and stuff as a government, you're paying whatever they cost. If you're putting roads and airports and hospitals in the US, you're paying the cost of that. And if you're trying to put greener economy in again, so we're slightly different, I think, we're slightly insulated as a relatively nimble, smaller company in these times of high inflation. Our commodity is something that's essential, right, and our customer is an essential spend, rather than, you know, you haven't got any money in your wallet because of what's happening and you choose not to buy a new car or a new whatever. You know, our customers, this is essential spend.
Are you seeing much uptick in the operational costs because of this inflation figure that we're getting?
Yeah.
We've got the Fed raising interest rates, trying to stop prices rising away.
Yeah.
But your input costs, are they rising beyond your control?
They are rising. Now, up to today, the price was rising faster than the input cost. So from when we listed the business, you know, we had an idea of what the cost would be. The costs are higher than when we listed. But when I listed, even from October the 19th, I think we listed, the sale price of coal was about $140 a ton. Even today, it's gone from 140 to 450, back down to sort of 260 where we are today. But even at 260, the rise in the price of the coal is far outreached the rise in the cost of raw materials, fuel, and the like. But they have gone, of course, they've gone up for everybody. But it's unlikely, right, with the rising prices that we're going to see the price of met coal back down to where it was when we listed. So I would expect, after the Russian ban comes in, because of the nature of the demand and it being government-led, that you will see prices in our sector rising faster than the cost of the goods we need to make that coal.
Okay. As of the last time I saw this reported, 6th of June, I think it was, you admitted to having 5 million sterling on the balance sheet of cash. What's that earmarked for? Are you a big cash burner? Clearly, you're getting income.
Not really, but you've got our trains that come. Most of our again, it's environmentally more friendly, but most of the way we ship the coal is via a train. So we're producing about 40,000 tons of coal. We might get trains at the end of the month. So at any one time, I might have, and I have now, about 40 to 45,000 tons of inventory. If that inventory is selling, you know, let's take the current price, $260, you can see that you've got a huge buildup of inventory until the train takes it away. And then there's a lag prior to post the train going away with you to get paid. So that working capital just funds the business. You're building a large inventory. You're not shipping it every day in a 20-ton truck. You're typically, a unit train has 11,500 drinks. So, you know, these trains are a lot of money each time. So the cash is we're not a cash burner, but we have to build inventory and sell it on unit trains, which are 11,500 tons. If it's 200, you know, that's what is that, $3 million a train. So that's why you need cash in the business. And of course, if anything goes wrong, we're a capital intensive business. We're a mining company. I have to pay up front for my fuel and for the labor and stuff like that. So it is good that we have cash, especially in these you know, current times where I think companies will find it harder to raise cash. We shouldn't need to come back to the stock market again. I hate to, you know, things do change, but all things being equal, we shouldn't need any more cash. We are now producing enough. We're profitable. We're cash flow positive, but the cash we've got is just to fund inventory. If, say, the train was a week late, you know, that's $4 million. You're a week late. We would have that on the balance sheet.
Yeah. Let me bring up a share price chart, the
Sure.
shape of which you will know intimately. We are down not too far away from levels that we've not seen since February time. Just explain what's been going on and what's priced in at these levels. What do you see as being representative of this current share price for Ben Creek?
Well, again, if you had another chart, and perhaps your viewers can access it, if you were to put met coal pricing on top of that, at the top of the price at 100 and whatever that 110, I think that met coal was at $450 a ton. Now it's all to our bottom line, so our costs are relatively fixed. I mean, the more we produce, they do drop slightly. But just as a simple example, if we were $120 a ton cost and $450 is the sale price, you're making $230 margin. There are some other costs in that, so we were never at, but certainly we were approaching $200 margin at the top. If you're producing 1 million tons, that's $200 million of earnings, not of profit, not of revenue, of earnings. So, you know, that's fantastic. It's a very profitable business. With the met coal falling, it has the reverse effect. Every dollar that the price falls, you're getting a lesser dollar. So if you mapped met coal on top of the share price, you'd see a huge correlation in the two prices. It's my contention, we will see, that you're seeing an artificial pressure on that met coal price as Russia has literally 10 more days, 10 or 2 more weeks of being able to sell that coal. Then it becomes illegal. Once that price picks back up again, you know, I would expect to see the share price, you know, fully reflect that. It doesn't exactly match it day for day, but if you layer one over the other, you'd see a very simple match. And of course, that fall, the way shares are traded, that fall with the met coal price has allowed some shareholders have had to sell the stock, whatever, as the stock has come down with the met coal price.
Adam, let me just quickly go on. We've got time's almost beaten us, but I wanted to ask one more question about the big shareholder on the register, MBU Capital Group, holding 59%. What was the genesis of that involvement at that sort of size? And what's their interest in the business? Are they happy to sit on the sidelines, or are they going to run that proportion of share ownership down?
No, they're there historically. So when I found the asset and wanted to buy it, it was bought from Investec. They're a huge bank. Investec wanted to see not just Adam Wilson, they wanted to see a financial hedge fund with some regulated with some firepower. So when we bought the company from Investec and we moved their 60 million of debt from a debt to a royalty, we pay them $2 a ton. So over, you know, if we produce 100 million tons over the life of the thing, they'll get paid back $200 million. That was the deal we struck. I needed a large hedge fund to fund me, and they wanted a guaranteed investment in, even before we listed, to remediate the wash plant, the wet railway line, the underground mine adventures, so that they had a chance of getting that royalty deal. So that's where MBU came from. It funded the business 100% ahead of the listing. That's how it got its shareholding. And in return for them guaranteeing the funding, which we then didn't actually need in the end because we raised proceeds from the IPO, they got their shareholding. I wouldn't have been able to do the deal without them. In terms of their position going forward, I am hopeful this is a profitable business. If the met coal price goes back where I think it will do, it becomes a very profitable business. We've already locked in 8 trains now to the end of the year, all at profitable margins. What I hope to then do is turn this into a dividend paying stock. So we've already talked about our intention to pay dividends next year. I would like in the calendar year next year to repay the price we listed at, because that would be a great return for every shareholder, certainly if you bought it on list at 10p. So that's my target dividend payment for next year. MBU with that kind of shareholding would see fantastic returns out of dividends at that level. The dividends wouldn't be fixed there. We don't need capital. We're profitable. So I would be looking to return the capital to shareholders, much like a Thungela, which is another coal listed company, very, very cash generative, pays its shareholders back. So I would like to pay a large portion, myself as a shareholder as well, each and every year out through the dividends. So I don't expect MBU to be selling down. They don't need to. We can return them fantastic returns through dividends. Again, as the business, if we're on a decent margin, whether it's $50, $100, and you're making 1 million plus tons, that's a lot of EBITDA. That's margin, not revenue. And then again, if I can pay that all out to shareholders twice a year through dividends, it's a great business.
What would trigger that? Because that's obviously of critical importance when you see investors dancing around a stock. They want to know what the returns are like. What would trigger those sort of dividend payments when you see the business running?
Well, again, it's margin. It's all about revenue and margin. There's a huge demand for the product. So the revenue is not a problem. The margin is driven by the price and my operating costs. again, you saw the stock on your chart at 100 and something pence when we were, you know, the margins were over 200 margin, $200 probably 400 minus 100 cost. So if we can maintain the margins we've got now, and you produce, and then it's just about production. So I'm targeting to go through. We're at 40,000 tons today. Second high wall miner gets you 80,000 tons a month. Third high wall miner takes you through 1 million tons a year. If you're making $100 margin, that's $100 million of EBITDA. I can either sit on it or give it back to the shareholders. I'm telling you, Mike, I want to give it back to the shareholders, of which I have an interest in that, and so do you, Jeremy. I want to pay you back quickly for the shares you recently, I hope, happily invested in.
Okay, look, one final question. You've detailed the 10th of August deadline for the coal, Russia, and so forth. What else you got in your
That's
diary?
available online. Anybody can Google that.
What else have you got in your inbox that's you're committing to for this year?
Well, again, the key thing for us is to get this production up. Now, we weren't a producing company when we came to AIM. We've had a very nice share price rise, and new shareholders have come on, such as yourself. What you got to understand, we listed on the 19th of October. So the remediation of getting this up and running, we should be at the sort of 70, 80,000 tons of production, which is 1 million tons a year around the end of August. I'm then looking, if possible, and it may not be possible, if possible, I'd like to put the third high wall miner that we have. We have 2 rented, 1 purchased. I'd like to put it on site. We're looking into that. I can't promise that will be the case. But then I want to go through the 1 million tons of production at the right margin figure. This is a cash cow type of business. It's a very simple business. We're not looking to do anything else. We have enough land. We're adding reserves. We've already got 92 million tons in situ, 22.5 million. And we put that reserve study out recently. People can read that. We put the whole study on it. So I've got enough mining here for way longer than I'm going to be here. We will continue to add to those reserves. We've got, I think it's nearly 17,000 acres of land. So there's plenty of coal here. We want to mine from the infrastructure out. So we want to start as close to the wash plant and railway plant as we can, and then extend the business. But we're not looking, most of this company's already been built. The railway line was key. There's no chance of putting another railway line smack bang in the middle of the Appalachian Mountains it just won't. It was built 100 years ago. We've remediated it, and we did it when the costs were low. We fixed up the wash plant. The wash plant can do 2 million tons a year. So I'm not even if I get to 1 million, I'm not even at full capacity on the wash plant. There's plenty of coal. The reserve studies are there for all of the investors to have a look at, and we will only be improving them and adding. Yes, we'll be mining that thing, but I will be adding to those far faster than we're mining, because it hasn't really been extensively drilled for high wall mining. And so it's really about running these machines. We're not going to be the biggest producer, but we're going to be one of the most profitable producers. We have no legacies. There is no debt in the company at all. There's a few convertible loans, but they're all unsecured. So there's no chance of a hedge fund coming in and taking over the company. Virtually no debt. All of the improvements have basically been done. You can always do more, but the big ones, the high wall miners in place, the permits, the underground mine, the wash plant, the railway, all being fixed up with the shareholder money that's coming. We didn't just raise, we raised £7 million at list. We had a very institutional shareholder added another 2 convertible notes at 6 million. So we have raised extra. All of that spent on getting this thing up and running, which it is there. We have plenty of videos on site. Any shareholder that comes to America with enough notice, welcome, including yourself, Jim, welcome to come and have a look around the site. We welcome that. There's nothing, we're trying to hide anything here. And now it is really just about, it's like a cash cow. You just got to mine the coal. It's a commodity. So at the end of the day, the met coal price is key. But if it goes anywhere like I hope it will do after this 10th of August, this is a very profitable business. And I'm very proud to be running it. We've got a great team here, and you know, we've done a lot in the 6 months we've been listed.
Okay, look, we look forward to some more updates later on in the year. But in the meantime, Adam, thanks indeed for joining us. It's a pleasure to catch up
And
with you.
Appreciate you taking an interest in us.
Okay, Adam, that's great. Thank you. That's Adam Wilson. He's Chief Executive of Benns Creek. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.